Hello and welcome to our AIM Summit webinar on impact investing and ESG asset allocation. I'm your host, Zachary Sefaradi. It's a pleasure to be with you today. I'm the CEO and founder of Downman Capital and the strategic partner of AIM Summit. This session is being sponsored by FactSet. We thank you so much for joining. We have participants from over 40 different countries around the world. I recognize some names in the group. We have institutional investors, family offices, high net worth individuals, leaders of the financial services industry amongst the audience. We'll be having a Q&A session after the presentation, but feel free to submit questions as they come throughout the session through the Zoom Q&A dialogue you can find at the bottom of your screen. If you are joining us on YouTube, please like this video and subscribe to the YouTube channel now to stay in tune for AIM Summit webinars. And be sure to look at the AIM Summit website to see how you can participate in some of the live webinars, interactive Q&As, so that you can engage in real time with some of the speakers. Our partner for this session, as I mentioned, is FactSet. This is the third session that FactSet has partnered on. They are driven by two core values, innovation and partnership. For over 40 years, they've relentlessly created open technology, delivering clean, transparent, aggregated data to their clients and designing solutions to be available anywhere, anytime. FactSet is proud to have been recognized with multiple prestigious awards for analytical and data-driven solutions, both regionally here in the Middle East and Africa, as well as globally. Joining us today is Pascal Wazin-Papier, the Vice President and Regional Director of Middle East and Africa of FactSet. Here at Downman Capital, I can say that we use FactSet and we love their data. Great product, great platform, really great team, excellent to work with. Pascal, thank you so much for being the host of this webinar session.
Thank you, Zachary, and thank you for your feedback. It's great to hear the trust that our clients, and thank you all for joining from all around the world. As you may have heard, 2020 marks FactSet's 10-year anniversary in the UAE, and to mark this milestone, we wanted to engage with our community and run a series of webinars to share helpful insight from market professionals. I'm really delighted and honored to be here, as it's the last one that we're running. The subject today is impact investing and ESG asset allocation. It's a topic that has gained a lot of interest in the last decade, as investors understand the importance of transparency, environmental issues, social cohesion, and conscience on companies' performance. 2020 has certainly placed ESG and impact investing in the spotlight, as the global pandemic has changed society's values and has given decision makers a wake-up call to address important topics such as climate change. On a personal level, this subject is important to me, especially when it comes to human capital, diversity, and gender equality. The subject raises several questions, and just to name a few: how will responsible investment affect the asset management landscape? What will influence investors? And what role does regulation and reporting play in setting the right basis for socially responsible investments? Will this trend persist? Let's see our speaker's view on the subject, and without further delay, I hand it over back to you, Zachary, to introduce our esteemed speaker and launch the discussion. Thank you.
Thank you, Pascal. And without further ado, it is my pleasure to introduce Peter Rockefeller. Peter is a board member and vice chairman of Rockefeller Philanthropy Advisors and a managing director at Brock Capital Group. Brock Capital Group is a full-service investment bank organized in 2002 to provide strategic advice and implementation support. Peter has an extensive background in finance and investing, with experience in private investments, corporate finance, mergers and acquisitions, capital markets, private equity, and investment strategies. Prior to joining Brock Capital Group LLC, Peter was at G2 Investment Group, an early-stage private investing firm developing innovative structures in the private equity sector. He's also worked at Berkshire Capital Services, a New York-based M&A firm focused on servicing clients in the investment management and securities industry. Prior to Berkshire, Peter worked at Citigroup, at Private Bank in the Global Investment Strategy Group, and at Donaldson, Lufkin, and Jenrette in the International Banking Group. He has a BA from Dartmouth College and an MBA from the Tuck School at Dartmouth. Peter, it's such a pleasure to have you with us again today. You've been an alumnus of the AIM Summit in the past. It's such a pleasure to, again, have you. We'll be having a brief presentation from Peter, followed by a fireside chat, and then a Q&A at the very end. But again, remember, just ask your questions anytime. We will be monitoring them in the dialogue and getting to them at the end of the session. Peter, again, such a pleasure to have you, and over to you.
Well, thank you, Zachary, for that introduction, and thank you, Pascal, for your organization sponsoring this series. I'm very pleased to be able to speak a little bit on impact investing, area of great interest to me and to a lot of my family members as well. As Zachary mentioned, I serve on the board of Rockefeller Philanthropy Advisors, which is basically a consultant to foundations, family offices, and other institutions on philanthropic activities, not least of which is the impact investing sector. RPA, as we call the organization, has done a lot of work in the impact sector, and has recently issued what they call a handbook on impact investing. And my presentation, which will start in just a second, is based on that handbook. So without further ado, let me just start my presentation, and we will go through that. I think we're all set then. So just beginning, as I mentioned, Rockefeller Philanthropy Advisors has recently published this Impact Investing Handbook. It is a pretty comprehensive guide to the sector, with case studies and a lot of theoretical analysis behind it. So anyone who's interested in reading it, it is available for download. The link down there is at the bottom of the screen. But ROCPA, excuse me, .org is the website of RPA. So we're going to talk today about some of the evolution of impact investing over the years, some of the important elements as it is practiced today, and then we'll finish up with some considerations that an impact investor might want to be aware of. First of all, let's start with a definition. What is impact investing? And I would say that it really starts with a sense of values and the sense of an asset owner that the assets that I own should be aligned with my values. This plays out on many different levels, and we'll go through some of that. But as it has been taken to be, it's more of a formal definition now, and it appears there that investments are made with intention to generate positive and measurable social and environmental impact, as well as producing financial returns. So the intent of the investment is considered to be quite important, and the measurement also is key. So those are kind of underlying principles of the discipline. And it also observes, of course, that every investment has some kind of impact. So it's not possible to go without having any impact at all. So let's go through some history. This is a very complex slide. I'm not going to try to go through all of it, but just to say that there's been, probably as long as people have been allocating capital, there's been some sense of allocating for social good as well as for financial reward. But in the late 60s, in the US at least, this is a slightly US-centric presentation, which I apologize to our global viewers, but directionally it is similar. But the US Congress first made provision for what's called program-related investments by foundations in the late 60s. In the early 70s, the first socially responsible investment fund was launched. And in the 70s, really the focus was on what was called socially responsible investing. This started out really with kind of a sort of negative screens, avoiding investments in companies that were active in tobacco, alcohol, particularly egregious polluters, various other kind of social or environmental kind of no-nos. Over time, though, the thinking evolved to a more focus on more positive impact, to encourage companies that were doing good things, whether it was in education or community development or environmental, all different areas, but more of a sense of, let me put my money in a positive direction. Obviously, that's what it evolved until a bit of a watershed in the 2000s, the aughts, when in 2006, 2007, the Rockefeller Foundation published a study based on work they'd been doing for a number of years on impact investing as a more structured discipline. The term was first coined by the Rockefeller Foundation, impact investing, 2007, and at that time they also launched the Global Impact Investing Network. The GIN, as it's called, is a kind of umbrella group to act as a clearinghouse, a meeting place, a think tank, and a center of standards. It's not the only such group. There are many around the world, but it has had a kind of a leading and a central role in the impact investing world as it has developed over the years. Also notable, in 2015, the United Nations established what are called the Sustainable Development Goals. We'll go into these more later, but it was a series of goals that they proposed the world should meet by the year 2030. And then just this last year, in 2019, the US Business Roundtable changed their kind of definition of what the purpose of a company was, going back to Milton Friedman's essay back in 1970, saying that the purpose of the company was to make money for the shareholders. This declaration last year expanded that responsibility, not just to shareholders, but to stakeholders as well. So that was signed by over 180 US corporations, and really marks a profound kind of refocusing of how companies think about their role in the world. In terms of capital, this graph just shows how capital in which is invested with kind of a ESG awareness, which is environmental, social, and governance, which is something of a screen and structure. But the money there has been growing, particularly in the last decade. You can see the investments have tripled up to the level of $12 trillion. This, of course, is a bit of a rough estimate and is kind of the broadest definition of socially aware investing, but certainly shows that the amount of interest in the world in this kind of investing has grown dramatically and has become very mainstream. So I want to go back and talk a little bit more about the Sustainable Development Goals, the SDGs, because they have really formed a kind of a structure. And I just want to read a definition that's been released about the SDGs that says that they are the blueprint to achieve a better and more sustainable future for all. They address the global challenges we face, including poverty, inequality, climate change, environmental degradation, peace, and justice. So as you see, there's 17 goals. And each is fairly specific, and then within each one there are sub-goals. And as I mentioned earlier, the intention is that these goals, specific goals, measurable goals, be met by the year 2030. and the United Nations staff that developed these went and actually costed out rough estimates of what investment would be required over the years between 2015 and 2030 to actually meet these goals. And they came up with an amount roughly $4 trillion a year. Quite a large amount. As you can see on the graph on the left, there is some money being spent in those areas, but there is a huge need further. And these are specific investments. These are places where capital needs to be allocated in schools, economic development, infrastructure in the emerging world, clean energy. It's the whole gamut. And the importance of the SDGs really they've become kind of a consensus framework for many investors to kind of form their own impact work. Some investors will focus on one goal, others have a broad goal. Some companies will point out how their work, whether it's their product or the way they do business, supports other goals. So they've become very much a structure for the whole impact investing world. And as you can see, over 50%, almost, well, 60% or so of impact investors are actively saying that this is their framework. So they've become a very important element of the impact investing world. As we talk about capital, and I want to show here in this slide the relative size of different pools of capital. You see philanthropy on the left and private investments on the right, several orders of magnitude of difference. So clearly it is the private capital, the investments where the money is going to come from to meet the Sustainable Development Goals. Obviously, private capital needs a return in order to be allocated, unlike government or philanthropy. So this means that this capital that's allocated really has to be investment capital, and that really makes impact investing central to the further development of the world. Going on then to look at the range of capital that is impactful. We have in this chart on the left traditional investing where only the financial return is considered, over to the far extreme of intention where philanthropy is only trying to make a positive change without any regard to the return, the financial return. I just want to point out that the range here is intention and not return. In other words, you don't necessarily have lower returns as you change your intention. But looking at the orange circles, the first moving from the left is the ESG screen, or environmental social governance, as I mentioned before. This is, from an investor's point of view, is the investment that I'm considering. Does it meet certain environmental social governance standards? And if not, I won't make the investment, and I will seek out investments where the company or the entity is meeting those goals. It's not just a screen though, because it has become, for companies, it has become something of a stamp of approval. If they can say demonstrably that they are adhering to certain ESG standards, then first of all, they have to be able to demonstrate that is the case, whether it's committing to zero net emissions or certain benefits in terms of planting trees, building schools, any number of different things. including how their workers are treated and how they interact with their stakeholders. So it becomes somewhat aspirational and something about a seal of approval for an investor, but fairly passive in terms of the investor's intention and work. As you get further to the right with more intention, there are other investments which can get much more impactful, including the most impactful investments probably are private investments, where the investor's capital would not will catalyze or enable a beneficial activity that would not otherwise have occurred, whether it's investing in a startup, clean tech, or renewable energy, or any number of other impact areas. But private investing is in some ways the cutting edge. I also want to say that there are elements of impact investing that are willing to accept what they call concessionary returns. That is where an investor may make, say, a loan to a company that's doing good work at lower than market rates, or to a community foundation, where there is some return. The capital is expected to be returned. There's expected to be some profit in it, but the investor is willing to take less than a market rate. While that exists, studies that the Global Impact Investing Network has made, and as well as others, show that the vast majority of capital that is looking to make an impact is looking for a market return. So given whatever the risk of the investment is, people, institutions want to have similar returns as they would get if they did not have the impact intention. So it just shows that the trade-off is not really something that most capital wants to accept in terms of less return. Coming on to diving a little bit deeper, and I won't spend too much time on this detailed slide. This gives a little more structure to how one might focus one's investing. On the left is, the column on the left looks at different themes in the impact world: community development, climate, energy, water. Obviously, there's a long list of other themes that one might be focused on. Then across the top is different kind of allocation strategies from a more financial point of view. So from liquidity, wealth preservation, capital appreciation, inflation, and kind of making a bit of a grid. It points out various investments that one might make. On the liquidity side, we see things like community bank, CDs, green bank deposits. Moving across, probably most of the kind of focus right now is more on the tech side, clean tech, energy technology, water technology, tend to be in the private equity side or the hedge fund side, so private investing. But there is, as you can see, a wide range of opportunities for someone who is looking to invest capital in the sector, with a wide range of liquidity, risk profiles, return possibility. So it's become a very large world. I can go into much more detail. Obviously, this is kind of the meat of impact investing, but I only have a certain amount of time, so let's mention that more broadly. So that, I think, is a bit of an overview of some of how we got to where we are today and some of the opportunities that an impact investor has before him or her. We mentioned at the beginning in the definition that in addition to the intention, the measurable impact is an important part of impact investing. So here is a little bit on the measuring part. It's obviously very difficult, certainly compared to financial measurement, where there are universally accepted standards of financial performance, financial impact. But in terms of impact investing, it is so much softer and so much more varied that it is difficult to establish a simple set of standards, given that one person might be looking to improve education in Africa, somebody else might be looking to fight pollution in the Pacific, someone else might be focused on climate change. So all very different dimensions of positive impact in the world. But nonetheless, it is important that things be measurable, both because that is what the money is being put in place for, but also the world needs accepted standards. So one investment can compare itself to another, and some kind of performance measure for managers or allocators of capital can be developed. So again, this is a complex area where a lot of work has been done from the principles side, where impact investing principles have been developed. The United Nations has their principles for responsible investing. There are other principles, and that goes all the way through to the actual standards of how things are measured on the right side. The most interesting, I think, is the, well, both the IRIS Plus, which is a set of standards that's been developed by the Global Impact Investing Network, and also the SASB, which is Sustainable Accounting Standards Board, kind of a corollary to the FASB in the financial world. So this, again, is a complex area, but very important to really the overall discipline and for the investors. I'll finish up with a final slide, which talks about another more legalistic consideration, and that is the fiduciary responsibility. One of the early issues with people looking to have other considerations besides the financial returns was that if they were looking at something that wasn't financial, they must inevitably be sacrificing the financial returns, and that was not to the benefit of the client. Obviously, for an individual managing or investing his or her own money, not so much of an issue, but because the majority of money, capital in the world is managed institutionally by third parties with a fiduciary responsibility to their clients, this is a very important consideration. So a lot of study has been done, and it's been discovered that many studies, over a couple of thousand studies actually, that the correlation between financial performance and impact intention is actually a positive relationship. In other words, more impactful, more aware investments have tended over time to somewhat outperform investments made purely with financial considerations. So it's an area that is less of a worry. There's also been a growing awareness that many non-financial aspects of an investment are truly important, regardless of the values of an individual on where they might want to allocate their capital, but things like functioning ecosystems, climate that is not creating storms and damage, and various other aspects do actually have benefits to the world. So the fiduciary responsibility actually can and actually should encompass quite a bit of impact considerations. So it has really been settled, I think, now that is not something that the investor needs to worry about. So I will wrap up there. I know we're going to have some discussion, but I hope that gives, I hope that gives you a bit of a sense of where the impact investing world is today. And again, as I said, the handbook is available online. And I'll just say thanks then and look forward to your questions.
Thank you so much, Peter. We already have a lot of questions coming through the Q&A dialogue. Again, please continue to bring in questions. There's some great questions that we'll get to in a little bit from the audience. But before we hand over the Q&A, Peter and I were just going to have a brief fireside chat. There's a fire over here. You can't see it on the camera. I mean, Peter, what are some examples, real live examples of impact investments that you are involved with and working on?
Well, I will mention my biggest focus at the moment is in the sustainable agriculture area. And I'm working with a group of farming experts to develop an investment platform. It turns out that farming and farmland investment, farm operation, is a much better investment than is kind of popularly supposed. And then there's also a great deal of additional benefit, both environmental and financial, in farming in a sustainable manner. And there are practices of farming which use much less inputs in terms of chemical fertilizers, pesticides, much less disturbing of the ground. And there are multiple ways in which that benefits both the health of the soil, so that the soil becomes more resilient to drought and other problems, more productive because it has better health. And also the soil can once again become a net absorber of carbon dioxide as the organic content in the soil increases. Obviously, a big part of anything organic is carbon, and plants tend to, in a lot of their life cycle, be absorbing carbon dioxide and converting that into other organic matter, which is then deposited in the soil. So some people have estimated that many megatons, gigatons of carbon dioxide can be absorbed by farming in this manner. So very exciting, both in terms of financial return and also in terms of kind of climate impact. So that's really been the main focus I've had recently.
So actually, while we're on the agriculture space, if you could maybe, is sustainable agriculture, if we're talking about impact investing as agriculture, does that mean only organic, or is it, can that also, refer to conventional agriculture? Can you maybe give some examples of what types of agriculture investments might not fall within the impact category?
Sure. I guess what's come to be called industrial agriculture is the kind of chemical-based, machinery-intensive, large-scale agriculture that's practiced certainly in the Midwest of the United States, but in many parts of the world as well, where the soil is seen not so much a source of nutrients as more almost just a growing medium. And so this is because over time, intensive farming has depleted the organic matter from the soil. Erosion, which stems largely from plowing practices and planting practices, has also washed away a great deal of topsoil around the world and continues to do so. By farming differently, farming not just organically. Organic is somewhat different than sustainable, where organic more focuses on kind of what goes into the plant, and sustainable more focuses on the soil and the health of the ecosystem. Often both are very aligned, but they're not the same thing. It's just a matter of, some of the practices are interesting, where there's something called no-till farming, where rather than plowing the lands, plant a crop, seeds are just what they call injected into the soil or drilled into the soil. That by not disturbing the soil, that means the structure of the soil, which is found to contain just a multitude of bacteria, insects of various kinds, fungi, all of which form a very complex and very beneficial web to the soil. And when the soil is disturbed, those are all disrupted. So leaving the soil in place is very beneficial. Planting what they call cover crops, also very important. And this is once the main crop has been harvested. Under traditional or conventional farming, land is left fallow until the next growing season. So over the winter, say, in the United States. What that means is that bare earth in rain or melting snow can be eroded very easily. Any organic matter that is there tends to decompose and turn back into carbon dioxide and other substances. So depleting the organic nature and content of the soil. And of course, bare soil also gives weeds a chance to get established. So the idea with the cover crop is a kind of a short-lived grass or other plant can be planted, which will then continue to nurture the soil, cover the soil, hold it in place against erosion, and also choke out weeds. So it's been found that practice, the drill, and various other practices, some of which are kind of ancient and very traditional, others which are very cutting edge and scientific, can dramatically, over periods of time, improve the soil. And so as the soil health improves and its productivity improves, fewer pesticides, herbicides are less needed. Fertilizer is less needed because the soil is hanging on to the nutrients. Water, the ability of the soil to retain water is improved, which both makes the land more drought resistant, but it also reduces the runoff, which again, both causes erosion, but also carries away nutrients from the soil, and they show up in water as really as pollution. So kind of a double negative. So those are some of the reasons that there are great benefits to sustainable farming. And we see it many parts of the world. It's still probably a smaller part of overall agriculture, but growing, and a growing awareness of the importance and the benefits to the farmer, both long-term in terms of the soil environment, and even in the immediate term in terms of his bottom line year to year.
Peter, just getting a few notes from the audience, a quick housekeeping note. It sounds like there may be something interfering with the mic on your side. Either way, I think the audio quality could be a little bit more improved. So hopefully that improves some adjustment. Otherwise, if you could potentially speak a little bit more loudly or close to the mic, there just is some interference, it sounds like. But so we have many would-be impact investors in this audience. Some are experienced, some are looking into impact investing, but have questions on where to start. What are some resources that you could recommend for a would-be impact investor on how they could potentially get started investing in the space?
I would point certainly to the Global Impact Investing Network. They have a website which has a wealth of information and resources, references to other publications and other organizations. there's grown up a whole kind of mini industry of funds that will invest investors' capital for them in various kinds of impact. Some are private equity type funds, other venture capital, where they might be focusing on things like clean technology. There's a lot of software that's focused on energy management, on precision farm management, things like that. And then there are certainly public companies like an electric car company or an organic clothing company where people can know that their investment is kind of aligning with those particular values. I'd also say that the whole kind of asset management world is turning much more towards an awareness of the ESG values and of impact. Larry Fink of BlackRock last year said on one of his statements that BlackRock was going to be taking the ESG factors into consideration as they manage their vast portfolios. So many opportunities, but certainly the GIN is as a resource. The Philanthropy Advisors Handbook that I mentioned is also, and there are many other organizations that are focused in this area. So I think a fairly short Google search would turn up quite a few of them.
So as you've highlighted, there is an increasing focus on this space. This is, again, more and more conferences talking about impact and ESG. It's becoming an increasingly important topic in many other circles besides just at the few that it kind of used to be discussed. And you see more and more organizations either developing negative screening processes or going for very strongly into impact investing. What do you, if you could had a crystal ball, what would you say is the future of impact investing? What do you see happening? What are the trends that you think will shape the future of this style of investment?
Well, I think a growing awareness of both the possibility for maybe a more conservative investor, but also the need, really, particularly in something like climate change environment, where we need much more renewable power, for example. We need smart grids to allocate power, energy storage. The need and the opportunity are both there. So I think that there's more awareness for those reasons. I think also it's becoming much more of a gauge by which companies are measured. We've seen many cases where executives have lost their jobs for sexual harassment. Now, that's not an investment sector, obviously, but it shows an awareness of another set of values and ways of measuring people. So I think that continues to grow, and the kind of the stakeholder approach to a business's activities and approach is of growing importance. So I think impact is just becoming more woven into the awareness of everyone who invests. So I think as we move forward, they might be less of a distinction between investing and impact investing, where there'll be less investing in something like coal power plants, for a very strong example, and more of a sense that if you're going to invest in power, you invest in renewable power, say, or clean power. So I just think it's working its way much more into the mainstream.
Certainly, and certainly it seems that companies are realizing that if they're going to continue to tap into good sources of capital, they need to clean up their act as well and improve the impact that they're having. So potentially companies that are finding themselves on negative screening criteria lists are not finding the capital that they would like otherwise. So I think that not only is there obviously increasing investment in the space, but more investable opportunities in this space are continuing to emerge, and more companies are realizing that they have to those that can have to adapt themselves to try to improve the impact that they're having on the world. So certainly capital can be a strong motive for change. Handing over to some of the questions that we have from the audience, we have quite a big Q&A. We have 19 questions now. We have actually a few questions that were sent in advance of the webinar. So one of the first questions that we have is thinking about the real long-term impact investments where you may not see a return for more than a decade or many decades, such as in forestry and sustainable forestry. At the moment, a lot of these investments, don't tick the boxes for a lot of investors, because many investors would like to see a return sooner than later. Going for conventional products with green window dressing, as the audience member. So what do you think could be done to help the kind of term horizon of impact investing improve? Do you see impact investing, can you invest on the same kind of term horizon, or are impact investments tending to be longer dated investments?
I guess I'll make a distinction between a public company and a private investment, because certainly a company, Tesla, to pick a name, as someone would have realized quite a nice return just this year in Tesla by buying and selling. So, quite short term in that sense, given the stock price. The places where the investor is not buying a public stock or an existing fixed income bond, but is actually allocating capital to a new project. It's obviously private initially, and so it doesn't have the liquidity. So the time horizon usually is a bit longer, whether it's in venture capital, private equity. It's usually a 3 to 5 or more year time horizon. But certainly something like a company, say a new tech company developing new technology for some aspect of impact, could probably expect to be demonstrating its effectiveness in 5 years or so. Whereas, as you mentioned, forestry and sometimes even agriculture as well, it is long-term. And often there isn't a kind of catalyzing event which radically increases the value of a holding and makes a logical time for an investor to sell. Certainly the venture investor often wants to get out at the IPO. Whereas a farm, if it's gradually increasing in its productivity, and then is going to be producing a steady return, but low risk, but not as high as others, there's no catalyzing event. So it tends to be a longer term investment. Often, it's something like a farm or a mature forest. There is revenue generated from the production, whether it's the trees or the crops, but it tends to be lower risk and lower return, as I said. So something more akin maybe to a real estate investment, where rent is earned, and there isn't that catalyzing event that would make someone sell the asset.
So there's actually been a question around different countries, regions. This one highlights the Middle East and US as examples, where there is a difference in kind of popularity of impact investing. You certainly see, for example, the Nordic countries being very, very strong in impact investing. You see some other countries being weaker. Do you mind highlighting some of the countries that you've seen be very ahead, very strong in impact investing, some that you think may need have room for improvement, and any insights into why there is such a differentiation?
Gosh, I'd hate to speculate on motivation, but certainly the Northern European countries are probably the most advanced and may have something to do with maybe sort of a sense of community, a sense of there being other considerations beyond just finance for what makes a successful person or a good life. But certainly you do see in the Nordic countries, in Holland, Germany, UK even, much more of a institutional investing focus on impact and ESG. In the United States also you see a great deal of it. But you know, why it's less in other countries, I wouldn't want to speculate. But I think it is a kind of very, why it is happening in those countries it's coupled, I think, with, you know, with stronger maybe environmental awareness or awareness of other social ills that can be addressed through application of capital.
Yeah, absolutely. So I can understand it is difficult. I've never understood why some countries haven't adopted it. It's I would also say it's quite difficult to pick out any particular data point or differentiation in motive. But I think at this stage it seems like it's too big and too important to ignore. And even those countries that are maybe a little bit behind or starting to adopt and implement, certainly nations that are not yet industrialized but may have capital may see more challenges in kind of upbringing their people, and certainly for example, the Kyoto Protocol has assigned a lot more responsibilities to the highly developed nations rather than to developing nations in terms of their responsibility for green and impact investing, allowing those that are not fully industrialized to still go through the industrial progress that other nations benefited from. There are actually a couple questions, and maybe you know, certainly for Peter, but possibly at the end of the session, Pascal could mention some resources as well regarding the access to data. Are there lists of ESG compliant investments that people can choose from? Are there, you know, you mentioned screening criteria. What resources are you aware of? Do you utilize that people could potentially subscribe to or learn about in order to develop their ESG strategies, screen appropriately, select different investments?
Specific resources. I don't have any kind of actual handbook or publication I can point to, but I do know that there's a great deal of focus in the area, and even in the popular business press, one could find a lot of reference to ESG investing. So I would look at the you know, the publications of business magazines, business websites, and also a lot of the big investors. I mentioned BlackRock before, but you know, Fidelity, PIMCO, Allianz. There are many big groups that do have an explicit focus on ESG and can provide investment funds for clients.
Yeah, so I mean, I guess one of the challenges that investors face is when impact or even ESG are used as a kind of marketing term. And I think people are becoming increasingly skeptical. And one of the questions, again, from Anne Fosamale is discussing exactly this issue. How do we distinguish from genuine impact from, she referred to it as impact washing, that gives a bad name to genuine impact investing? And is that an issue that you've seen?
Yeah, I mean, certainly we see it. Greenwashing is another term when it's more environmentally focused, where an airline says they're going to be net zero, but it means they're going to be, you know, having offsets, planting trees, so they continue to fly jets. Pretty hard to do anything else, but or there are other places where they it can be purely marketing communication effort. So I think, in the research that individuals or institutions do on companies, that's certainly one of the things they look at. And that's another reason why measurement is so important, because to the extent a company says we are treating our workers well, that's one thing, but it's, do they have a family leave policy? Do they have other aspects to employment? You can look and see kind of beyond. So within the kind of the ESG framework, there are some specific milestones or metrics that the company is expected to meet or to be actively working towards. So it's not just a not just a name, not just a word.
So one of the other questions is, so we have terms like ESG, right? Environmental, social, governance, and SRI, socially responsible investing. Is there any way that you can differentiate between these two? How can people, how can people focus on what is something that might be ESG and not SRI, or vice versa? Is that something you can help people distinguish? Because these terms get thrown around, and I think it is important for people to understand that there are hard and fast definitions in some cases, and others not as much.
Yeah, I mean, there are obviously a lot of names, and I think and a lot of them it's more art than science. I mean, certainly the definition of impact investing, it's the intention and its measurability. Screens are, can be less precise, but also, a lot of these terms are used interchangeably. SRI, ESG, various other ones, and there isn't any agreed on sort of hard and fast difference. So I think the practices are more important maybe than the terminology.
Interesting question from Ahmed Abdullah Kanu. So, I mean, we're living in a crisis right now, a crisis that we were warned about, right? Bill Gates for years, many experts for years were warning us, we need to make more investments in the space. There's going to be a pandemic. We need to be prepared. And a lot of those warnings were ignored. Budgets were actually cut in a lot of programs that were fighting these risks. And as a result, it's actually estimated that if without a vaccine by 2024, that as much as $35 trillion could be wiped off of global GDP. Now, projections are saying that by the time a vaccine is developed, we're going to be looking at around $8 to $12 trillion being wiped out of global GDP. But that is serious capital. That is a serious loss of productivity, and that will never come back. So do you think that in this post-COVID world, that there has been any shift in thinking, that people are realizing, maybe these experts are right, maybe the better time to act is before, and potentially again with the ongoing climate crisis? Yes, well,
I think maybe you're optimistic to say post-COVID. I wish we were there, but it seems like we've got a ways to go yet. But you're absolutely right. I mean, the world tends to be reactive, tend to be kind of emergency focused. Long-term planning is not something that governments, or maybe democratic governments, are good for, especially when there's a lot of expense involved. So people can't predict the future, and it is tough. It is very helpful. We see countries where there was more explicit preparation have had much better experiences through the pandemic. So yeah, I mean, in terms of wiping off GDP, it is a real shame. It's a lost opportunity. It's really something that didn't happen, although for many individuals, it's income that they don't have. So it has a real human cost to it, and it is it's a real shame. And I think one of the things that people are working on, we're saying that the impact of climate change is going to get worse, and I think people are broadly people are beginning to believe that because we're seeing it happen. So it's kind of in that sense, the future is here.
Well, the future is here. That is a very strong word to I think, draw to the end of this session. I'm so sorry that we haven't been able to get through more of the questions. We have 19 open questions, but we will follow up, and the AIM Summit team will contact some of the members to see if we can provide some answers to the questions. A few people have asked about the presentation, and that presentation is going to just be distributed to everyone who registered via email after the event. Thank you very much, Peter, for agreeing to share that. Again, I cannot thank you enough for having this. We really did cover so many areas. We discussed what is impacting investing. You walked us through some of the definitions, some of the importance. You highlighted the $2.5 trillion annual funding gap that is needed to meet the Sustainable Development Goals. And again, that is, it seems like when I say post-COVID, I mean since COVID, or we're in the COVID world.
No, of course. I just wanted to tease you there.
Not after COVID's gone, because I'm not sure it'll ever be gone. But
yeah, it's true, sadly.
But certainly, I think it really has opened people's eyes to the danger of ignoring these issues, and again, companies that have been aligned with providing. Look at the biotech stocks and industry. There's profit in the space. It's a way to make money. This is not only philanthropy, and it was so helpful to highlight that spectrum. The fact that there is a spectrum between philanthropy and pure finance, and your intent and what your intention is along that spectrum is what defines what type of impact investing you'll do. Again, I cannot thank you enough for this session. Pascal, if I could hand over to you for a couple of closing remarks as our host and sponsor of the session.
Yeah, thank you, Zachary, and thank you, Peter, for the insights today. It was really very interesting. I just want to address the data question, as you mentioned, Zachary. So one of the issues our clients see is consistency. Like, how do you score? Like, how do you use the ESG scores? And I don't want to do like kind of a publicity for some of the data providers that we integrate, because FactSet does integrate third-party providers that you can link with your proprietary data, and then also with FactSet data to crunch it all into analytics and risk. But I would invite, I'll put it in the chat, I would invite people to go on the Open FactSet website, where you can look in the catalog, and if you type ESG, you'll see there are more than 40 providers just giving us ESG relevant data. Same thing also, you can check the Insight website, where there's a lot of literature on that is written either with our third-party providers or with our specialists. So this is for the parentheses around data. And I was telling the team just before we started the session that I'm emotional a little bit today, because this marks the third webinar that we've been doing with the AIM Summit. So I want to warmly thank the AIM team, Raha and Flores, and yourself, Zachary, with Dalma Capital. It's been a pleasure, and I hope that our also audience have liked the series that we did for them, and I can see from all the questions and the attendance that it really resonated well. So thank you very much, and I hope we see you again soon.
Thank you so much, Pascal, and thank you to everyone at FactSet. Peter, I cannot thank you enough. As a repeat AIM Summit alumnus and speaker, we always love having you. The audience clearly loves hearing from you. I mean, we couldn't even get close to all of the questions that people had to ask. So it really was a pleasure to have you on the session today. Next week, we will be having a session following the recent announcements of UAE and Israel developing a path towards cooperation we will actually have with us an Emirati businessman, Dr. Sabah al-Binali, CEO at Universal Strategy, as well as a prominent Israeli businessman, Jonathan Medved, founder and CEO of OurCrowd, who are going to be talking to us about some of the investment opportunities that this peace agreement has opened up. So be sure to join us. That's going to be Thursday, October 1st at 4 p.m. Gulf Standard Time, 2 p.m. Central European Time. Again, remember, if you are joining us via YouTube, please like the video, give us a thumbs up, subscribe to our YouTube channel. Again, thank you to everyone for having us. It's such a pleasure to have you all in the AIM Summit family, and hope to see you on our next session. Thank you all.